Hi, everyone, and welcome to AIADA's Auto Talk, our last program of the year, and boy, is it a good one. I'm your host, Rachel Soleimani. For our newer listeners, anyone who has registered for today's program will be receiving a copy by the end of this week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Now, please join me in welcoming our good friend, Cox Senior Economist Charlie Chesbrough. Charlie, a lot has happened since we had you last on in September, and I feel like I'm always saying that, but it's so true now more than ever. So I am going to give you the floor.
All right. Well, thank you, Rachel. And yes, a lot certainly has happened really through the course of this whole year. But we're actually finishing on a little bit of a positive note. And so I think there is some optimism as we're heading into to 2025. But I'm going to walk everybody through today on the economic and automotive outlook, give you an update on what we're seeing out there in the economy and what we're seeing right now for the automotive market. And I have to say, just to give you a quick summary, it's all looking pretty good. The economy appears to be on a good trajectory. There is concern about a potential recession, but I would say that the percentage likelihood of that is fairly minimal right now. And when we look forward into 2025, most of the indicators are suggesting things are headed in the right way. The big uncertainty we're facing at is really all around policy and what the new administration is going to do. So we're going to talk a little bit about that. I'm going to talk a bit about affordability changing. The prices are starting to move into buyers' direction now, so that's going to help vehicle sales next year. That's in part why we're somewhat cautiously optimistic into 2025. And then I'm going to talk a little bit about the alternatives, the plug-in vehicles, the traditional hybrids, and the battery electrics, how they've really been selling great this year, but all of that is at risk depending on what President Trump does. And we'll review some of that. But let's start by talking about consumer sentiment, because this is really a key component of the U.S. economy. We need confident consumers to go out there and buy vehicles, people who are comfortable about their economic situation, feel comfortable about their job. Those are the ones who are going to go out and borrow $50,000 to buy a new vehicle. And this is a chart from the University of Michigan that's showing monthly consumer sentiment going back almost 50 years worth of data. And you can see where we are there on the far right. We are recovering from where we were in June of 2022. And June in 2022 is when inflation reached that peak of 9% around the country. Gas prices reached a peak. And consumers in this country felt it was the worst times ever, at least according to this metric. Going back over 50 years and all the other crises that we had in the U.S. economy, including the 9/11 terrorist attacks and the Great Recession, consumers thought that June of 2022 was even worse. And we're slowly crawling our way out of that. But you can see that where we are today, we're still far behind sort of our long-term average of around 85, 90 for consumer confidence, and certainly below where we were pre-COVID. So that kind of sets the stage, and that was what we had going into the election. And I think that's part of the reason that we had a change election, is that people are still not quite confident about the U.S. economy. And even though economic growth is headed in the right direction, prices around the economy still remain high. And one of the areas that we can see that clearly is in gasoline prices. This chart is showing the weekly average gasoline prices around the country. And again, on the far right, you can see where we are today. It has come down from the peak that we reached in June of 2022, but it still remains elevated, and it remains higher than what we had even during the previous administration, during Trump's first term. And in fact, gasoline prices during the Biden administration versus the Trump administration averaged almost $1 higher, or 40% higher. And so when people say that there's still concern about out there that the economy is not great, that prices are still high, well, this is still certainly one of the things that they're looking at. Because nothing really impacts the American psyche more than gasoline prices. It's a cost that they see every day that they're filling up. It's a cost that they can't escape from because there's really not many alternatives to having to fill up that gasoline tank. And so it really has dramatic effects on the American psyche. And so that was one of the main issues that we dealt with coming into this election. Now, the University of Michigan also does that survey of consumer confidence where they split it out by party affiliation. And so I'm showing consumer sentiment by party affiliation here. And you can see that where we are right now, we had the November data point. We haven't gotten their December number yet, but we're seeing a huge swing upward for Republican leaning people, red state folks. We're now seeing that their confidence, which was very muted during the Biden administration, is now starting to get much more optimistic. And vice versa, we can see the blue line is now starting to head down, that left-leaning folks are going to start seeing that glass is half full. They're going to be more concerned about the economy. And we've seen this before, that the way people see the world changes dramatically depending on if their candidate won or lost the election. And if we go back through this chart, you can see back in 2016, when Trump first took office, how quickly red state folks responded, and all of a sudden they were very happy, whereas they weren't so happy, and blue state folks got much more pessimistic. And then when Biden won in the fall of 2020 and took office in the spring of 21, you can see there was a big switch again. Well, we're expecting that that's going to happen again, and I really just point this out to you because it means that who's coming into your store here over the next few months may be a different buyer than you had before, that we're going to see more red state type folks coming out to buy a vehicle because they're now going to be that much more confident in the U.S. economy, while blue state folks are probably a little bit more concerned now than they were before. So who's going to be buying vehicles may be changing here in 2025. And it wasn't just the University of Michigan that was showing a big jump in consumer optimism for the red state folks. We're also seeing it in our dealer sentiment index. We had our fourth quarter numbers that came out about 2 weeks ago. And this is showing what is dealer optimism over the next 3 months. And you can see on the far right here that it's taken a big jump. And in fact, we've had our highest jump in the history of this measure that we've had. Really kind of a shocking result that dealers out there are very excited about the outcome of this election, and we're seeing that reflected in their sentiment. Now, that's not to say that all of a sudden profitability is going to get that much better, and I'm certain that everybody's hoping that that's the case. But certainly the overall outlook of where this economy is headed has definitely made a large movement into the right direction. And part of that reason is the fact that the election is over. When we had asked folks, what are the factors that are holding down your business? You can see right in the middle of there, political climate, a significant fall in the way dealers out there were saying about their concerns about the political climate. They're not as worried about it now. And I think that's one of the outcomes of the election, is that many folks were worried, maybe not so much about who was going to win, but how they were going to win, and whether we were going to have a bunch of craziness like we had 4 years ago in the whole January 6th debacle. Were we looking at that again? But fortunately, this election was decided rather decisively. It doesn't appear we're going to have that kind of uncertainty. And so that's having an impact on how dealers are seeing the world. They're less concerned about that political climate. And interest rates are coming down. The Fed has been lowering interest rates. They're going to be having a meeting right now as we speak, and they're going to announce new interest rates tomorrow. And the expectation is the Fed's going to lower a quarter-point interest rate reduction tomorrow, and then we're going to have more of those in 2025. How many is the big question. That's what folks are going to be looking for from the Fed's guidance. But again, that's going to be moving in the right direction. The one area where dealers are saying things are getting more challenging out there is the competition. There's, I think, a lot more cutthroat pricing out there, and certainly much more aggressive advertising. All of that is making it a more challenging marketplace. But overall, dealers are a little bit more optimistic as to what 2025 is looking at. But there's certainly a lot of threats out there. And one of the areas that's a great threat is under tariffs. And this is a chart that's looking at all the different manufacturers and where their source of sales is coming from. Where were they produced? And you can see Lucid, Rivian, Tesla, they're nearly 100% produced. Tesla's got a dabble of China in there. But for the most part, they're 100% USA made. And so the threat of tariffs aren't going to affect many of these new EV entrants. And then the exposure to these tariffs, however, varies greatly among the legacy manufacturers out there. You can see Ford and Stellantis have very large U.S. footprints, so they're not as vulnerable to these tariffs if they come. But if Trump goes after Canada and Mexico, that's in purple. You can see that both those manufacturers, as well as GM and Honda, do have a large portion of their manufacturing coming out of other NAFTA regions. And then when we get into tariffs coming from offshore, such as Europe or Asia, you can see that some manufacturers have significant exposure to if President Trump gets very aggressive on tariffs coming from other parts of the world. So it's certainly a major threat that's hanging over the market this year, but we really can't build in the impact of any of this stuff until President Trump actually does it. And we know from history that he loves to talk a good game, he loves to rattle the cage and threaten a lot, but not necessarily translating that into actual action. And so it's a kind of a wait and see approach whether these tariffs actually come, but certainly it's not going to have a positive impact on vehicle prices. And that's certainly one of the risks that we're concerned out there. Another risk, just to put it out there for food for thought as you're thinking about things over the holidays, is what Elon Musk is going to be doing in this new administration. He's got the president's ear, for better or worse, and there's all kinds of things he could be whispering into President Trump's ear to tell him of things that he'd like to see happen. And one of the things he's talked about is autonomous driving and self-driving vehicles. And Elon Musk had a big press conference back in September where he announced that the RoboCab or the RoboTaxi was going to be in production in 2026. That he feels that Tesla is very close to having full FSD, full self-driving available. And I have to say that if and when that technology is actually rolled out and works, it could be a real game changer for the industry. And we're already seeing self-driving vehicles on the road in mass in parts of the country. Google's Waymo is operating all over San Francisco, Los Angeles, Phoenix. They're soon going to be adding Austin and Atlanta. And so self-driving is out there. And one of the ways that Elon Musk could speed this along is that he's going to have the president's ear, and that he could be working with President Trump and the new administration on getting rid of some of the regulations which exist around the country about self-driving vehicles, because Elon has stated that those regulations are one of the biggest obstacles that they have out there. And so this is something on the horizon I think everyone should be aware of. And this is part of the reason that Elon Musk is not even interested in a $25,000 electric vehicle, because he feels that the low end of the market is going to be served by these driverless taxis that are going to be driving around. At the cost of per mile is going to be substantially less than what we're getting right now with Uber. Getting rid of that human in the driving seat will lower the cost substantially. And so the issue is over the long term, does this drive out private ownership? Do the folks who actually own their own vehicle, certainly in urban areas, become less and less and less because they're able to fulfill their transportation needs with these low-cost autonomous vehicles? That's more of a 2030 plus issue, but I think it's something to put on the horizon. And just one more little nugget to it is that over the long term, it seems likely that insurance costs are going to fall to zero on the robo vehicles. And it means that all of the costs of insurance are going to fall entirely on humans, because at some point, once the software is perfected, it doesn't make mistakes. And when it does make a mistake, it'll be rewritten and corrected. And so when an accident happens, it is more than likely going to be the human's fault. And so these rising insurance costs may fall on humans, which may push ownership, individual ownership, out of the realm of affordability for many Americans. Again, this is a longer term issue, but this is what Elon Musk is kind of bringing to the table that could kind of accelerate all of this move that much more quickly. So there's a lot of uncertainty around what President Trump will do with his new policies. But as I said before, he's inheriting an economy that appears to be on very, very solid ground. And just looking at inflation, this has been public enemy number one the last couple of years, but it has improved substantially. And you can see on the far right, this is showing our the year-over-year change in the consumer price index from the Bureau of Labor Statistics. And you can see that inflation has improved dramatically from where it was in June of 2022. The Fed started tightening monetary policy, raising interest rates, and they've had great success in bringing down inflation. The most recent data point we had was 2.7% in November. It actually ticked up a little bit. and it still remains well above the 2% target that the Fed has, but clearly it's moving in the right direction. Some of the segments of the measure, like housing, are going to be very difficult to move. It's going to take a long time to get those housing price contributors down so that they're not keeping inflation at a higher level. But when we look at prices of many products and foods, they've come down quite a bit, as well as gasoline prices on a year-over-year basis. So there are parts of the economy that are improving dramatically, but still we're not quite there yet. And so this is why the Fed is going to still be more aggressive with interest rates here going forward. And what the Fed was trying to do is can they slow the U.S. economy without sending us into a recession? And thus far, it appears that that soft landing has been achieved. Looking at the unemployment rate, you can see here I've got almost 70 years worth of data. You can see that it really puts into perspective what we've been through here the last couple of years with the COVID crisis and the huge spike in unemployment that we've had. It's come down. And unemployment has more or less been relatively stable at around 4% over the last 12 months. And so it does appear that this soft landing has been achieved. And there was a lot of concern that this was not going to be possible for the Fed, that they were going to lead to a reduction in job creation that was going to tip us into a recession. But as I said, that has not been the case. And when we actually look at job creation, this is the monthly numbers from the Bureau of Labor Statistics. We can see that job creation has slowed as these interest rates have risen over the last year and a half. The job creation rate has slowed, but it has not fallen into negative territory, and it's more or less been stabilizing at around 170,000 jobs each month. So more or less where we were back in 2019. So at this point, it does appear that this soft landing that the Fed was so desperately trying to achieve has been accomplished. And so our expectation is that the Fed is going to continue with their interest rate reductions. And as I mentioned, they're meeting right now as we speak. They're probably going to be announcing a quarter-point interest rate cut tomorrow at the end of the meetings tomorrow. And then the guidance has been that investors are essentially expecting 4 more quarter-point increases in 2025, maybe one each quarter. What we're expecting to hear tomorrow is whether that guidance still holds or whether the Fed may be pulling back on that. Maybe not quite as aggressive, maybe only one or two cuts next year. That's what Wall Street's been waiting on. Stock prices have been falling over the last week or so as traders are anticipating what the Fed's going to say. And there is concern out there that maybe we're doing so well that the Fed doesn't need to cut rates as much as folks thought they were going to have to just a few months ago. Certainly, if there's fewer interest rate cuts, that doesn't help automotive sales quite as much, because certainly lower interest rates would help lower that monthly payment. But it doesn't appear that we're in a situation where there's any kind of crisis that has to be managed at this point. But there is some clouds on the horizon, and one area has been consumer spending. And consumer spending, which is you and I going out and buying stuff, that's about 70% of all economic activity. And this chart is showing from Equifax data. We have some measures that we look at that is credit card spending on a weekly basis. And this is the year-over-year change in that weekly credit card spending. And you can see it's quite volatile, but that orange line is showing the 4-week moving average. And you can see that essentially over the last couple of months, it's been sort of slipping down a little bit slower, and it's now fallen below 2%. And so there is some concern out there that consumer spending has been weakening slightly. We're not in recessionary territory just yet, but if we see that orange line head below zero and into negative territory, that's certainly something that would be a very negative indicator that the economy is slowing and folks aren't able to spend as much. So that's something that we will be keeping an eye on, but we're certainly not there yet. So average loan rates around the economy are starting to move in the right direction, at least for vehicle buyers. This is showing some of the major interest rates in the economy. The dotted red line is the federal funds rate. That's the overnight lending rate, basically the key lever that the Federal Reserve pulls in order to increase or lower economic activity. And you can see on the far right that the Fed has been starting to lower interest rates, so that dotted red line is starting to fall. And in correspondence to that, we see the orange line and the blue line, new and used uh, 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 APR rates are also starting to come down a little bit. So the interest rate that's being offered out there to car buyers is starting to improve just slightly. What is interesting, though, is that the U.S. Treasury, that green line, has not slipped down. In fact, the longer term treasuries have actually strengthened a little bit counter to what we might expect. That we would normally think that the 10-year Treasury would come down along with the overnight rate. But there's concern now that the economy is actually doing so well, and that President Trump's discussion of implementing tariffs may be inflationary, and so that there's some concern that longer term U.S. economy may be looking at more inflationary pressure. So many of the longer term financial investors out there are keeping U.S. Treasuries relatively high because they are concerned about that long term inflation threat. And that may make the interest rates for new and used auto loans not be able to fall as much as they might normally. So that's, again, one of the things that we're going to be looking at. The other important thing that we're seeing out there that's going to help vehicle sales is that credit availability is improving across the economy. This is a chart that comes from the Federal Reserve, and it's their loan officer survey. And they talk to loan officers around the country and they ask them, is your bank tightening your standards for your new and your used auto loans? And that's that dark blue line there. And you can see that many banks were saying, yes, we are tightening standards. Certainly during around the COVID crisis, they said, yes, we're tightening our standards significantly, which means they're not going to be lending quite as aggressively. And when the Fed started to raise interest rates, we can see on the far right there that they responded by making the requirements tougher to be approved for these loans. But you can see that those measures are starting to come down. And it's now back more or less to sort of neutral territory. More banks are not saying that they're going to tighten their standards. They're essentially sort of in a neutral territory. And this is across the economy. When we look at the orange and red lines, that's looking at banks that are tightening standards on their commercial and industrial loans for medium-sized and large-sized and small-sized firms. And again, you can see it follows a very similar pattern to what we saw on the auto side, that there was quite a bit of contraction, that there was banks saying that, yes, we are limiting our credit availability, but now it's starting to move in the right direction as the Fed has been lowering interest rates. So when we look forward, we do think that there's going to be significantly more credit available out there for vehicle sales in 2025. So that's going to help spur more sales activity. And when we look at auto lending, it's also showing positive indications. This is a chart, again, from the Federal Reserve that shows the total amount of auto loan originations in billions of dollars. And the key takeaway here, well, there's a couple key takeaways, but one on the far right, you can see that in the third quarter, we actually ticked up a little bit. We had a 3% gain in the amount of auto loan originations from the second quarter. So there's more money that's being made available for the automotive sector for lending. So that's a good thing. And you can also see that during this period where we had inflation in the U.S. economy, that where there was real growth in auto lending was in the green and the blue bars here. And these are your most affluent, your highest credit rating customers out there. These are folks with subprime of 720 and above. And they really have been what juiced the market these last couple of years in this post-COVID high interest rate environment. Those folks coming to the marketplace and buying vehicles is what's been keeping things going. The other interesting nugget on this chart is subprime share, and that's what that red line is there. And that's showing what has been the share of the lending that's being done out there that goes to folks that have very poor credit ratings or below a 620 FICO score. And what's really different is you can see that during the Great Recession, subprime share really peaked. Almost 30% of all auto lending was to folks who had very, very poor credit ratings, a 620 FICO or below. That's a really risky loan to be making. And certainly when the economic collapse came, it really made for all kinds of troubles out there. But now you can see that subprime share is relatively low, that we've had much more affluence in the vehicle market in the years since the Great Recession. And so now who makes up vehicle buyers today is a much more affluent vehicle buyer. And so subprime share is very, very low. And in fact, it's only about 15% or 16% of the lending that's being done out there. So uh, the credit quality that's being made available in auto lending is much better than we had before. And that's why, even though we are seeing delinquencies and defaults at elevated levels, it really hasn't caused any kind of crisis just yet because we still have very solid folks out there that are borrowing in the auto sector. But affordability is still a major issue, and monthly payments is really the public enemy out number one out there right now. This is from our dealer track data, and it's showing the average monthly payment out there for a new purchase, a new lease, and a used loan. And you can see that right now, our most recent data point in November, we're looking at $782 was the average monthly payment on a new vehicle. That is a 21% increase from what the average monthly payment was back in November of 2019. So a substantial increase in the marketplace for what monthly payments are out there. When we look on the used side, it's even more. It's up 32%. $568 is the current average used monthly payment. Really a huge increase for households that certainly can't afford that type of increase. And leasing is currently at about $569, but it's only gone up about 12%. It hasn't had near the run up that we've seen in some of the other channels out there. And so we think that there's going to be more opportunity here for leasing going forward, and we'll talk about that in just a moment. So overall, our outlook for new vehicle sales, it remains quite optimistic. We figure that this year is going to finish around 15.8 million, and that's above the 15.5 million we sold in the new vehicle market last year. But what we're really seeing here is over the last couple of months, we saw a bit of a Trump bump. Sales pace has accelerated in the new vehicle market. In fact, the average SAR for the third quarter was about 15.6 million. That was the sales pace. In the fourth quarter, we're expecting the SAR to average about a 16.4 rate. And in fact, we're figuring December is going to be the highest point of the year, finishing tied with November at 16.5 million pace. So we're seeing quite a bit of a rush to market here as the year finishes. Uh, and that's, I think, a lot of folks that were sort of waiting on the sidelines to get through this election have finally decided, okay, the dust is settled. I'm ready to pull the trigger and come out and buy a vehicle. And we're seeing quite a bit of activity in many of the battery electric as well as plug-in hybrid vehicles, vehicles that may be looking at that $7,500 tax credit being eliminated on Trump's first day of office. So many buyers concerned about the potential tariffs coming in, potential incentives going away. They're seeing that now is the time to act. And so we are seeing a bit of a Trump bump. The big question is will that hold into 2025, or is this just a quick post-election surge? Really, only time will tell. But we do still remain optimistic that some of that splurge that we've seen happen is going to hold up. So let's talk a little bit about how affordability is changing. And I just want to talk a bit about what our outlook is on OEM performance and how the year is going to finish up for the different manufacturers. And a couple of big stories kind of emerge. One, GM is going to win the year. They're going to win the sales title of 2024. Our expectation is they're going to finish with about 2.7 million vehicles, up 4.2% from what they finished last year, and really kind of doubling what the national average was last year. So a relatively strong year for GM. Interestingly, though, where they're really seeing the largest gains is on some of their smallest vehicles. And in fact, Chevy Trax, their lowest priced product in their portfolio, probably had the biggest increase this year in terms of its contribution to their sales gains. If we had to judge sales success based on gains in market share, well, then I think Honda's going to take the title this year. They're looking at finishing this year with a 0.5 point increase in market share. We just got news today. I don't know if you guys have even seen this yet, but there are talks that Honda and Nissan are getting together for merger talks. So it is possible in 2025 that Honda and Nissan join forces, but they're at the early stages right now. But Honda's on a win streak right now, and Many of their new hybrid vehicles have been selling quite well, but actually where they're seeing some of their strongest gains is on their lowest price vehicles. The HR-V as well as the Honda Civic are looking at large double-digit gains this year. So there is this theme that manufacturers who have a solid low price offering are seeing some great successes from that low price offering. When we look at who's not doing well this year, well, certainly Stellantis is probably the leader in that. We're expecting their sales for the year to finish down about 15%. All of their major brands are going to finish in negative territory this year, and they're going to lose about 1.6% market share. So really a very, very tough situation for Stellantis, and certainly not having many low-priced products available for the marketplace as they pulled out of some of those low-cost segments has been a very detrimental to Stellantis here as customers in this market are looking for affordability. The other big story out there is probably Tesla. Tesla is looking to finish the year down a little over 6% for the year. This is going to be their first down year in about 10 years when they were just starting out back in 2014. And there's really not a lot to look on the horizon to say that Tesla is going to start flying off the shelves next year. The competitive environment for them continues to get more challenging as more and more legacy manufacturers are offering a whole plethora of EV products to compete. So the outlook for Tesla, on top of his own personal image issues, the outlook for Tesla still remains quite cloudy here for 2025. When we look at what's selling this year, there is a common theme that emerges from that, and that is affordability. Consumers seem to be looking for where can I get the best monthly payment or something that fits within my wallet. On the left here, if we look at where the changes in the marketplace are coming from, we can see that overall the market is up about 2%, but from the different channels, we can see it's retail leasing that we're really seeing the significant gains this year, up 19% from where leasing was last year. Clearly, that $7,500 battery electric credit is being leveraged for many vehicles out there into that monthly payment. There's a whole bunch of very low cost monthly lease rates being offered out there for these battery electrics and plug-in hybrids, and certainly that's contributing to the sales success. Where we're seeing the biggest decline by channel is on retail purchasing, folks who actually go out and buy their vehicle. That's down 5% on a year-over-year basis. Clearly, this affordability issue is a major headwind that these high prices and high interest rates is just out of reach for many consumers. And some folks that were thinking of buying probably decided to end up leasing because they can get a little bit better monthly payment, because leasing is generally a lower monthly payment. The other interesting thing that jumps out as to what's selling this year is that it's really the alternatives that are moving the needle this year. Battery electrics up 8%, plug-in hybrids up 19%, and traditional hybrids up 26%. ICE vehicles or internal combustion engines, they're down 2%. So clearly the Inflation Reduction Act, that $7,500 credit, is impacting what folks are buying out there. But traditional hybrids don't qualify for that $7,500. So something else is getting folks to be interested in those HEVs. And if you think back to that chart I showed you on gasoline prices, I still think there's a number of consumers out there that are still concerned about $5 gasoline and if it could ever come back again. And so that fuel economy still remains on the forefront of many vehicle buyers out there. And that's pulling them to many of these hybrid products that are out there. The other thing that's selling in 2024 is on the right. And that is that we can look at segment change in market share. And this is showing the top 10 vehicle segments. And that accounts for about 86% of the total new vehicle market. And we can see, where has market share really been gaining? Well, it's compact car, compact SUV, subcompact SUV. Combined, these three segments are up about 2%, 2 percentage points of market share. And where are they taking that share from? Well, mid-size SUV, mid-size car, full-size trucks, larger vehicles. They've lost about 1.4% in market share. And so it does appear that consumers are moving to products that fit more within their budget. They may be keeping the functionality. They want the SUV or they want the passenger car, but they're opting for the compact version versus the mid-size because that fits more within their budget. And just to hit that point home, the average MSRP of the three biggest movers this year is $33,570. The average MSRP for the bottom three is $54,482, or $21,000 more. So clearly there is some advantage to these smaller vehicles, and having a smaller MSRP is part of it. And this is a bit counter to the trends that we've been seeing in the industry. This is a chart that's showing the new vehicle market by different price bands and what share of the market is sold within these different price bands. And the big takeaway is that in 2012, 54% of everything that's sold in the new vehicle market was priced below $30,000. Now it's just 12%. But the key takeaway this year is that 12% is actually ticked up just a little bit, bucking the decades long trend that we've had of the share of $30,000 price point falling. It's actually ticked up a little bit because there is so much interest in more affordable products out there in the new vehicle market. But the industry has been moving to these higher categories for a long time. And where are they moving to these higher categories? Well, you can see it's the $50,000 plus price points is where we're really seeing the strongest growth. And it's really been the last couple of years of the $60,000 price point. And now almost 45% of everything that sells in the new vehicle market has an MSRP of $50,000 or more. So this affordability issue isn't going away anytime soon because the industry's kind of built it into what's happening in the marketplace. They're building products that cater to these different segments. But certainly consumers are still interested in looking for value out in the marketplace. And part of the reason is that they're concerned that prices are still too high. And just as I showed you at the beginning, the gasoline prices still remain elevated. Well, vehicle prices still remain elevated too. This is a chart that's showing the average transaction price from our Kelley Blue Book data. And right now, where it stands, we're at about $48,700 is the average transaction price. That's up about 1.4% from where it was a year ago. But if we never had the run up in prices, if we never had the supply shortage, I've shown you the trend of what vehicle prices would have been on. And you can see that in May in 2021, that red line really starts to take off. That's when inventory got really short in the market, and discounting went to a minimum, and average prices really accelerated. Had that not happened, that dotted blue line would have likely have been the trajectory for vehicle prices. And you can see that where we stand today is well above where that dotted blue line would be today. It probably has about 10% more pricing to fall. So consumers that haven't been in the marketplace looking for a vehicle in quite some time are still in for shock when they're looking at these prices, because they still appear to be a little bit higher than what they should normally be. And so this headwind is still going to be blowing on the new vehicle market in 2025, but it is starting to move in the right direction. But, not all brands are in the same boat. I know I've shared this slide with you before, but I think it's just important to note that that was on average. Transaction prices have gone up, but not all brands have been using the same strategy. On average, we've seen a 27% increase over the last 5 years in the average transaction price. But not all brands are looking at that same level. We can see on the far right here that Ram, Hyundai, Jeep, we're looking at 40% plus increases in the average transaction price. Really, these brands have priced themselves out of many of their traditional buyers. Certainly, that's been a major problem for the Jeep brand. But at the other end, you can see some brands like Tesla, which has been adding some lower cost vehicles to its portfolio, as well as cutting prices, as well as Subaru and Nissan. They didn't get quite as aggressive with their vehicle pricing. They didn't drop many of the lower priced vehicle segments. And so they're not looking at quite the vulnerabilities of some of their competitors out there when we look at this high priced vehicle environment that we're in today. When we look at inventory, that's fortunately an issue that appears to now be in the rear view mirror. This is a chart that's showing new vehicle inventory as measured by our vAuto data. And this in gray is a summation of what's on dealer lots and what's in transit around the country. And what you can see on the far right is that inventory today is back towards that 3 million level, sort of back to 2019 pre-COVID levels. And so really this whole inventory crunch issue that we were dealing with back in 21 and 2022 is now long in the rearview mirror. Inventory has reverted back to the way things used to be. I know many of us were pontificating that, oh, the industry's learned its lesson. We're never going back to the glut of too much inventory and having to discount vehicles. We're going to stay lean and mean. Well, that's not the case. The industry has reverted back to the way we were back in 2019. But this spells good news for consumers because this means that pricing is getting a little bit more favorable. But the key question is this the right amount of inventory? And that's that dark blue line, which is measuring the days of supply or how long this inventory will last. And nationally, we're at about 89 days is where it stands today. Again, that's more or less back to the levels that we were in prior to the great COVID hit that we took in 2020. So the inventory situation has more or less reverted back to normal, but it's quite different out there for the different brands, just as it was for pricing. This is looking at the days of supply for the major brands out there. Nationally, we're at 89 days, but you can see some brands like Jeep, Ford, Ram, they're looking at days of supply substantially above the national average. Some in the neighborhood of 120 days plus, 4+ months days of supply. So they're in a much different situation than those brands on the far left. You've got Toyota, Honda, BMW. They're looking at relatively tight inventory levels, certainly much better than the national average. And so we would expect that in those brands where inventory is accumulating, we're going to see the much more aggressive pricing, that they're going to have to start putting some money on the hood to move the metal versus some of their competitors that are seeing tight inventories. They're certainly under not near the level of pressure that the other brands are because their inventory is not accumulating at the same level. So all of this means is that pricing out in the marketplace is changing. And when we look at incentives, they're definitely moving in the buyer's favor. This is a chart that comes from our Kelley Blue Book data, and it's showing in dark blue there the incentive as a percent of the transaction price. And you can see that back in 2019 and prior to COVID, this ran sort of in the 10 to 11% range. That was the average incentive relative to the transaction price. This fell to just 2% during the lean inventory times back in 2021, 2022. But it's now been rising again as inventory has come back to the marketplace. So has incentives, and now you can see that we're back to 8%. That incentives have risen back to not quite pre-COVID levels, but pretty darn close. The other measure we have on here is the price strength, that green line. That is showing the transaction price relative to the MSRP. And again, back in 2019, this normally ran sort of in the 94 to 95% range. During the lean inventory period, this really strengthened tremendously and reached 102%, where basically the price of that vehicle was its MSRP plus the delivery charges. There was no negotiation to be had. But as inventory came back, so did the incentives, and this has now deteriorated to it now stands at about 96% is the transaction price relative to the MSRP. So this seller's market that we had just a few years ago, that's also in the rear view mirror, and now it's becoming much more of a buyer's market. But again, that's at the national view. And just as we were looking at the differences in inventory, we're seeing quite a bit of difference in the pricing strategies out there as well. This is showing the average incentive relative to the transaction price in the fourth quarter of 22, the fourth quarter of 23, and the fourth quarter of 24 of what we've seen so far in this fourth quarter. And you can see quite a variation out there in terms of incentives, but one common theme, and that is that incentives have been rising for all the different brands. Certainly everybody was sitting very tight, keeping incentives at a minimum when we had that seller's market, but everybody's been raising interest rates significantly since then. But you can see that Ram on the far right, with that huge inventory availability that they've had to get very aggressive with incentives versus their counterpart on the far left, Toyota and GMC to some extent, nowhere near the level of incentives that we're seeing from those on the far right. And so there's just not a lot of negotiation to be had for some of these manufacturers. And I would say for vehicle buyers out there, it means they're going to have to be very educated when they're out buying a vehicle this time around. It's going to be quite varied pricing, and who's going to be motivated to make a deal and who is not. is going to be quite different out there as folks are looking at vehicles here during Christmas week. So affordability is changing out there, but there is quite a bit that's at risk, and these alternatives are a big chunk of the market right now. And as President Trump has said, he wants to tear up the Inflation Reduction Act, and that could have huge ramifications for the vehicle market. And just to walk you through, as I showed you a little bit before on this, these have been a big source of sales this year. And if these alternatives went away, we probably would be looking at a negative market this year. We might not see the sales gain that we had overall. But at this point, alternatives are going to account for 20% of the vehicle market this year, and they may probably going to be rising to close to 25% of the market next year. Our expectation is that battery electrics are going to rise from about 8% of new vehicle sales this year to about 10% next year. Now, that's certainly, as I said, President Trump could change all that dramatically if he got rid of those $7,500 tax credits. But our expectation is he's not going to do that right away. There's a couple reasons for that. Certainly, a big chunk of the marketplace does not want to get rid of those things. Certainly, many car dealers would like to see those incentives stay in place. But there's also a whole bunch of vehicle product already out there at dealers that has to be sold this year. So even if President Trump pulled back on those incentives immediately, we still think there's enough electric vehicles out there in the ether that sales are going to still remain quite strong, at least for a few months, because other brands themselves are offering their own discounts. In fact, I think I just saw Toyota upped their BZ4 credit up $6,000. They increased their incentives today. So there's still a lot of incentive activity to be done on these vehicles, even if the Fed pulls back. But again, we don't think that that's probably going to happen, at least not immediately, because there are a lot of folks out there that do benefit from these vehicles being out there. But one of the things the president could do, uh, even though the Inflation Reduction Act was passed by law, so there are some things that he can't undo with just a stroke of his pen. One thing he can do is eliminate the IRS's recognition that commercial vehicles are exempt from many of the friendly country and income requirements to qualify for these $7,500 discounts. And if he did that, that would mean that they would no longer be able to offer that on the leasing, that capital cost reduction. And that's been a big part of what's been moving the needle since the Inflation Reduction Act was passed. This chart is showing leasing share of retail sales. And the Inflation Reduction Act passed in the fall of 2022. And you can see that plug-in hybrids, in response to that, we've seen a tremendous increase in the amount of leasing that's been done for those purple plug-in hybrids. And those battery electrics in green, you can see that leasing is about 50% of all of those battery electric sales out there. So if that $7,500 went away, it could have a significant impact on the market that would not be a positive. And the exposure for the different manufacturers to these alternatives also varies out there. This is a chart that's showing the share of vehicle sales that come from these different powertrains for these different manufacturers. And you can see that Rivian and Tesla, they're 100% electric, so they're all green. But you can see Toyota there. They get a big chunk of their sales from plug-in hybrid, or excuse me, from traditional hybrids, as well as in red there, ICE vehicles. But they only get a little bit of their sales from plug-in hybrids and battery electrics. So Toyota is probably not as vulnerable to President Trump ripping up the Inflation Reduction Act as some other manufacturers. And you can look at, Volvo, for example. They're taking a big advantage of some of these credits, as is Stellantis with many of their plug-in hybrids. So the vulnerability out there is quite varied as to who could suffer if President Trump decided to pull back on it. You can see on the far right there, GM, Nissan, Subaru. These are brands that are still very heavily reliant on ICE vehicles. Their lack of product for traditional hybrids, I think, is going to hurt them this year because that's a hot seller right now. People want those HEVs. But as I said, they may be insulated from any kind of downturn that we might have if President Trump pulled back on that $7,500 credit, because they just don't do much with battery electrics just yet. And then in terms of the around the country, there's going to be different levels of vulnerability if the president pulls back. And that's because EV sales, while approaching 8% of the nation nationally, they're still quite varied across the country. And this is looking at EV share of retail. So it's a little bit smaller denominator. So the percentage is a little bit higher. There's no fleet activity. There's very little battery electric in the fleet activity. But the key takeaway here is you can see some states on the West Coast there, California, Washington, Colorado, EV sales are 20% range. It's a huge portion of the vehicle market there. And many of these states have their own EV tax credits in addition to federal subsidies. Colorado, for example, has some big state subsidies. So electric vehicle sales could be hurt quite substantially if the president pulled back on that $7,500 for some of these dark blue states out there you can see. While as other parts of the country, it won't even be a blip on the radar. You can see in light gray, there's huge swaths of the country that battery electric sales remain well below 4%. It's sort of a non-issue at this point, and they probably wouldn't care if President Trump pulled back on those credits. So the reaction across the country is going to be quite varied, and the level of vulnerability is going to be quite varied as well. But again, this is something we got to be prepared for if President Trump decides to move forward on this. But one thing we know that's going to happen is that there's going to be great opportunities in the used market in the future. And that's because a lot of that leasing that we've been doing the last couple of years of these battery electrics and plug-in hybrids are all going to be coming back to market here and starting in 2025, well, later part of 2025 and into 2026 and 2027. And that's coming at a good time because when we look at the used vehicle market, we're in a little bit of a supply crunch right now. This is a chart that's showing off-lease maturities. So folks who bought their vehicle a few years ago and are now turning in the keys as their lease expires. And you can see where we are today. The number of lease maturities has been falling dramatically over the last couple of years. And this is reflecting the impact of the low volumes of sales that we did during the hard COVID years and the very small leasing rate that we did, the amount of leasing that was done. So that the number of off-lease vehicles coming back to the market here over the next year is going to be very, very low. And so we're looking at a real supply crunch in the new vehicle market, or excuse me, in the used vehicle market for these CPO vehicles. These are the darlings of what consumers want. They're getting all the bells and whistles of essentially a new vehicle without that new vehicle price. And they're going to be a very slim pickings for that. But as I said, when we look beyond sort of 2025, it's going to start to rise. And what that mix of vehicles that is going to be coming back is going to be many more battery electrics and many more plug-in hybrids. So although is a lot of concern about what's happening in the used market, there's going to be a whole bunch of new supply coming into the used market here in the next couple of years. And overall, we expect that the used vehicle market is going to start to see positive price growth again in 2025. Used prices have been falling at auction since reaching their peak there during the lean inventory period, but we think it's going to get back to more normal next year. And in fact, we expect this year to finish with prices down about 1% year over year. But by the time we get to December of 2025, we're expecting that Manheim prices are going to be back on the positive side, and we're more or less going to be looking at normal pricing behavior in the used market. So overall, just to summarize what we're seeing out there for vehicle sales for 2025, we again remain cautiously optimistic. We see the new sales market improving a little under 3%, a couple of 100,000 more units than we had this year. We see the retail market doing a little bit better, fleet sales improving a little bit, and again, really on the backs of more leasing volume. But again, this is all sort of under the assumption that President Trump doesn't do anything too aggressive. And that's one of the things I would say to most folks out there as you're planning your 2025, hope for the best, plan for the worst, have contingency plans available if President Trump decides to start implementing some of these tariff policies or Inflation Reduction Act policies, because they will have an impact on the vehicle market and one that could have ramifications relatively quickly. So those are my comments. If you guys want additional information, Cox Automotive is always publishing information on our newsroom. I suggest you go to our Cox Automotive site and look for any stories that we have written or the latest data points. We've got stuff up there that we update almost daily. And certainly, Rachel's going to share a copy of this presentation with all of you once we're done. So thank you very much.
Charlie, thank you. And thanks for coming on today and sharing this data. And I'm happy to hear about the positive outlook for 2025. I know that we're all kind of waiting with bated breath for a little bit, into the beginning of Q1, but it's good to see all these positive numbers coming through. We really appreciate our partnership with you and with Cox, and we look forward to having you back on in the spring when maybe things will slow down. Or I don't think that will happen, but we'll just have to see. Again, you'll all be receiving this presentation and recording by the end of this week. This was our last webinar of 2024. Thank you so much to each and every one of you for tuning in and helping make this program such a success. We'll pick back up on January 14th at 2 p.m. Eastern for a special session as Erin Kerrigan shares some buy-sell market predictions for the year. Joyous holidays, everyone, and a happy new year.